Hey, Richard. Thanks for joining me again for another Let's Talk. And so today, let's talk multi-strategy funds again. So the last time we talked multi-strats, we talked about why they'd done so well in 2022 and 2023. And one of the key things we talked about was central risk, and that central risk was a big part of why multi-strats are different from traditional funds and do so well. So what is central risk in the context of a multi-strat? What does that mean?
Yeah, thanks, Stephen. Good to see you. I think central risk, the important overriding idea about central risk is it is not an ex post reporting function that calculates VAR and attributions and generates PDFs, but it's an integral part of the portfolio construction process, and it works before risk is taken. Central risk works before risk is taken. The other part about central risk is that it happens at multiple levels, and perhaps should we go into that a little bit?
Yeah. When you say multiple levels, I mean, there's a lot of different parts of a multi-strategy fund. What does that mean?
Yeah. So as a starting point, definition of product universe is extremely important. So what are you trying to make, and what are your little components? Your components are individual strategy, individual funds within the master fund. So clear definitions of what each one is. Then within that, constructing those sub-portfolios in a way that maximizes the risk that those strategies want to have. So what are the drivers of profitability in that particular strategy, maximizing the exposure to that risk and minimizing extraneous exposures. Then at the next level, it will be allocating risk across those strategies so that the overall total portfolio is balanced, that has maximum benefit of diversification. Loosely call it a correlation benefit, but it is more complicated than that. And then at an even higher level, what some people might call a center book, but what we really mean is a sort of a central risk-taking function, not just ex post measurement, but actually centrally taking risk. And the purpose of that centrally taken risk is to either dampen overall volatility or to maximize use of liquidity, or in whatever way to make the best possible use of the information that exists within the sub-portfolios.
And so if I was to provide a couple of examples of that, because it's something I talk to people about a lot. So the first one, what you're talking about when you say universe definition. So for instance, there's been a podcast making the rounds where the CIO of Walleye talks about having individual strategies with equity strategies with the universe of no more than 100 stocks, right? So you have to stay in your lane because these are the 100 stocks you can trade. And there's an alarm that goes off if you can't. In terms of sort of the strategy risk parameters, I've talked to a lot of managers who want to try to run a multi-strat style book outside of a multi-strat, and they have in their mind that needs to be really high idiosyncratic or really high specific risk. And so that means that, if it's an individual multi-strat pod and they have to have 85, 90% specific risk, that's a lot of Google versus Microsoft and Coke versus Pepsi type trades, right? To get to that. And then the third one, that's the Izzy Englander, traditionally allocating dollars between this PM and this pod and this PM and this pod. And finally, to me, Citadel's the paragon of the center book concept. I've heard people talk about as many as 40% of the dollars that Citadel puts to work are put to work by the center book. 40% of GMV could be the center book. And so that's a lot of different levels. And so what you're saying is that number one, central risk means it's ex-ante. It's not a reporting function. It's not after the fact. And that number two, it has to be embedded in the process. The risk management's embedded in the fund at all different levels. Is that right?
Yeah, exactly. The purpose of risk management is to be built in to the product creation. And we constantly refer to the portfolio, the capital that's allocated is allocated within a product, a risk-taking portfolio. And risk management, ex-ante risk management, makes that a better product. And in this context of a multi-strat, without ex-ante risk management, you couldn't do it. It would not be possible to just expect that to happen.
No, I think that's absolutely true. And so I think, it's a great introduction to why central risk is so critical to multi-strats. So Richard, thanks for taking a few minutes to talk multi-strats. I think there's a lot for us to dive in on this topic, so we'll talk about it again soon.
yeah, look forward to it. Thanks again, Stephen.